Welcome to RBC's Markets in Motion podcast, recorded January 13th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, our thoughts on Friday's jobs report and reaction in the S&P 500 and Russell 2000. Second, what we're listening for in S&P 500 company earnings calls as 4Q24 reporting season gets underway. And third, updates on other high-frequency indicators, including a new chart comparing market cap and net income concentration for the biggest names in the S&P 500. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1, the Friday jobs report and reaction in financial markets. The continued dialing down of Fed optimism, which got supercharged by the stronger-than-expected jobs report, hit the stock market on Friday, taking the S&P down more than 4% below its late 2024 high and wiping out the S&P's gains for the year. Importantly, at the Friday close, the S&P was below levels that marked its low twice in December. With that move, we've been on the cusp of the 5 to 10% drawdown in the S&P 500 that we've been worried about for the past few months. A few other thoughts here. First, our rate strategy team has had us prepared for an end to the cutting cycle in early 2025 for quite some time. Our valuation stress test that bakes in RBC House views on inflation, the Fed, and 10-year yields, which we've just updated to remove their previous call for a January cut, the one cut they'd been looking for this year until they changed their call Friday afternoon, continues to point to a fair value of around 6,200 on the S&P at year-end 2025. That's the most conservative model in the 5 that we used to come up with our 6,600 year-end S&P 500 price target for this year. Second, a pullback in the S&P 500 has been overdue from a sentiment perspective, with AAII net bulls coming in 1 standard deviation above the long-term average back in October, something that has been reliably signaling short-term 5 to 10% drawdowns in the S&P 500 in recent years. As a side note, that gauge of sentiment has been falling since October, with net bulls back to 2.9% on the 4-week average as of January 9th, and minus 2.7% in favor of the bears on the weekly unadjusted data point. We think it's likely that sentiment will end up falling to levels similar to what was seen in the fall of 2023, when net bulls bottomed out at roughly 1 standard deviation below the long-term average. Painful for stocks short-term, but something that improves the setup longer-term. Third thoughts on Friday. Small caps were hit hard, which makes sense since this part of the U.S. equity market has been used to express increasing and decreasing Fed dovishness for much of the past year. Small caps failed to see a major outperformance cycle following the Fed adjustment cuts of the mid-1990s as well, causing us to also believe something more than a modest Fed cutting cycle has been needed to get small caps outperforming again in a sustainable way. Unfortunately, we just didn't get that something more from Friday's jobs report. Small caps tend to outperform when jobs growth is accelerating, a testament to how strong economic tailwinds can power outperformance in this part of the equity market. But Friday's print simply wasn't good enough to suggest that's the environment we're in yet. Moving on to takeaway number 2, what we're listening for as earnings season gets underway. 4Q24 reporting season kicks off this week with a heavy dose of financials and smattering of industrials. Next week and beyond, here are some of the things we'll be looking for color on in our S&P 500 earnings call transcript reading. First, will companies try to keep expectations low? Over the past year, there's been remarkable stability in bottom-up S&P 500 EPS forecasts, but one of the reasons why is that guidance issued in calendar 1Q24 was skewed heavily to the downside. Second, what are companies saying about cost pressures and margins? We've sensed more concern about costs in recent quarters, and bottom-up consensus S&P operating margin assumptions have been coming down since June. Layoff announcements have been low, and we'll be monitoring that issue closely in commentary as well, where the chatter has also been low. Third question, what are companies saying about the impact of the U.S. dollar? We tend to see downward earnings estimate revisions in the S&P 500 when the dollar is strengthening. Fourth, we're curious to see what companies are saying about taxes, tariffs, and the other big D.C. policy debates. In the initial weeks after the election, companies talked a lot at conferences about the benefits of easier regulation, but there was little discussion of tax policy. Meanwhile, there was a lot of tariff talk that focused on China, but very little acknowledgement of the possibility of broad-based tariffs, something very different than the 2018 experience. We're curious to see if this conversation evolves. Fifth, have we seen an unlocking of business activity for both consumers and corporates in the aftermath of the U.S. election? Throughout much of 2024, companies were talking about how U.S. election uncertainty was restraining business activity, and commentary on the election itself was well in excess of 2016 and 2020 levels. We're curious whether policy uncertainty on taxes and tariffs has been a new restraint on activity, or whether the passage of the election unfroze things. Note that third-party gauges of policy uncertainty have moved up recently on a variety of topics. And our sixth question for companies, digging deeper into the issue of the post-election vibes. We're curious to hear what companies are saying about the state of low-end versus high-end consumers. Last year's strength in the high-end offset weakness in the low-end, supporting the broader economy. We're curious to see if those dynamics are still in place, particularly since consumer sentiment, as tracked by the University of Michigan survey, has highlighted improvement in sentiment for lower income brackets and those with less formal education, while trends in sentiment for higher income consumers and those with more formal education have actually slipped. We've also seen a recovery in consumer sentiment for men on this survey, but a stalling out for women. And we'll wrap up with big takeaway number 3. What else jumps out on our high-frequency indicators? We'll do this one fast. There's one main thing we want to highlight. In early 2025, we've received several questions about whether the concentration of the S&P 500 market cap in the biggest names has been justified from an earnings perspective. And so this week we added some new charts to our deck, which look at the top 5 and top 10 names ranked by market cap and how their share of the S&P 500 in terms of both market cap and net income has evolved over time. While the market cap concentration in both the top 5 and top 10 names exceeds the net income concentration slightly, it's noteworthy to us that in terms of trend, both of these data sets have been rising. And that's just not something we saw in the late 1990s heading into the tech bubble of 2000, when the increase in market cap concentration was not accompanied by an increase in net income concentration among those same names. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.